So TD is now down only about 5% from their February highs. In a time of such low interest rates, also known as the predominant way that banks make money, it's very impressive that the bank has bounced back so much in a year that has really been quite devastating. If we take a look at the 5-year chart, this really does just look like a minor bump in a company that has been steadily growing. Hello and welcome to the Financial Future Guide. I'm your guy and I'm your guide. My name is Alex and today we're looking at TD Bank, which is one of Canada's big 5 banks. And given that they recently released their Q4 earnings report, I thought I would take the opportunity to take a look at this company and run you through some of the historical numbers, how the company's been doing recently, and any news that I think would be relevant. TD trades on both Canadian and US exchanges under ticker symbol TD. Now, a big reason that many people are drawn to the Canadian banks is not only because they are operating in such a well-regulated industry, but also because they pay nice dividends. TD Bank's dividend is currently $3.16 Canadian annually, which equates to 4.41% of their stock price. Now, I'm going to be honest, this is the second time I've recorded this video. I actually just recently finished it, realized I hadn't hit record, so here we go again. Now, just as I forgot to hit the record button, don't make the same mistake, make sure that you hit the like button. It really helps support the channel and it lets me know that you're enjoying these videos. Alright, without further delay, let's get right into it. A quick overview of the business: they have 26.5 million customers around the globe. They're the 5th largest bank in North America by total assets, and 86% of their earnings comes from retail. And retail just refers to people like you and me, in which we may go to the bank for a loan or mortgage. As we can see, the bulk of these earnings comes from Canada, but they still have a fairly large sector in the US. There are 2,308 retail locations in North America and 15 TD securities offices worldwide. Flicking over to the stock quote for today, and please note that all of these figures are in Canadian dollars. TD closed today at $71.92, that's up 23 cents on the day, or 0.32%. They have a market cap of $130.579 billion, and over the last 12 months have traded at a PE ratio of 11.19. Their earnings per share over the same period is $6.43, and over the last year they've traded anywhere between $49.01 and $76.10. As mentioned before, they're currently paying a dividend of $3.16 Canadian, which equates to 4.41% of their current stock price. Simply Wall Street, a great tool for all investors, offers an estimated fair value based on the cash flows the company is expected to generate in the future. Their fair value estimate of TD is $82.43, which means they're currently 13% undervalued based on this metric. As always, we like to look at the price to book ratio, in which companies that are below 1 could be potentially viewed as undervalued, whereas those with a higher price to book ratio may be trading at a premium. So taking a look at TD, they trade at a 1.4 price to book ratio, but I like to look at some of their competitors too to get a better idea of where investors are valuing this company in relation to their competitors. So first up is Bank of Nova Scotia, BNS, and they're trading at a 1.2 price to book ratio. And then we have RBC, ticker symbol RY, which is trading at a 1.8 price to book ratio. Now TD is trading somewhere in the middle of these two, but it is important to note a few things. Due to the countries that Scotiabank operates in, they have been hit harder than some of the other Canadian banks, as they have a larger country exposure where those particular countries have not recovered as quickly from the pandemic. And then we have RBC. So Royal Bank has been one of the best performers since this pandemic hit, and due to this, they are trading quite a bit higher than some of the other banks in Canada. So based on this metric, I would say that TD is trading at a fair value. Now, numbers are not always the most fun, but I am the Financial Future Guide and I'm here to crunch them for you. Now, first up, I want to take a look at the net interest margin. This is the difference between the rate received on loans and the rate paid on deposits. To give a quick explanation on net interest margin, if you put $1,000 into the bank and the bank pays you 1% interest, while that bank lends out that $1,000 and charges 3% interest, the bank would be left with a net interest margin of 2%. As seen in these figures, the net interest margin has been falling over the last 9 years, and this is really just due to low interest rates. It's also important to look at the loans to deposit percentage. Now, obviously, banks operate by lending out customers' deposits as loans and then charge a higher interest rate. The problem with this is customers' deposits on the liability side must be paid on demand and in short notice. When I want to withdraw my $1,000, I expect to get that instantly. Whereas if the bank has lent out that $1,000, that could be on a long-term fixed contract in which the bank may not collect that money for an extended period of time. So this mismatch between the illiquid loans and the liquid deposits poses as a risk for the bank if unusual events occur and requires them to immediately repay their customer deposits. Now, since TD's loan deposit ratio is 63.9%, this is well below the appropriate maximum of 90%. What this means is the bank is retaining a good level of their deposits, but as they are well below the 90% maximum, this gives them good headroom for growth in loans. Now, in a time of low interest rates where the net interest margin is declining, for banks to continue to grow their interest income, they will need to issue more loans. Now, TD's dividend growth is extremely impressive. Over the last 9 years, the bank has increased their dividend of no less than 7%. For a dividend investor, this is a very positive sign, and it's great to see that the company is rewarding their shareholders. Now, in times of low interest rate, it's important to generate non-interest revenue. And this is evident in 2019 to 2020, where the interest income fell dramatically. I think it's super important that banks are moving away from focusing on just interest income and are ensuring that they have other sources of revenue. With TD putting a great focus on non-interest revenue, it's a very positive sign to see for investors. They will be able to survive and weather the storm in low interest environments. Just to follow on from why it's so important to generate this non-interest income, the graph we're looking at here is the interest rate of Canada in the last 10 years. As you can see, the interest rate experienced a huge drop in early 2020, and it is now the lowest we have seen in 10 years. And more importantly, a few days ago, as expected, the Bank of Canada kept the rate steady at 0.25%, maintaining their pledge of keeping interest rates low until 2023. If we're going to have another year, if not a few more, of low interest rates, it's extremely important that banks have other ways to generate revenue. That's why I see this as a very positive sign that TD is looking for other ways to generate that revenue. Some of their 2020 financial highlights includes adjusted revenues was up 3% and the adjusted expenses were up 1%. I think a very important thing to note that TD did in 2020 was the transaction between TD Ameritrade and Charles Schwab Corporation. This makes TD the largest shareholder of a highly regarded US investment firm with $6 trillion in client assets. So a quick summary of Charles Schwab Corporation. They are an American multinational financial services company founded and based in San Francisco, California. They're the 14th largest banking institution in the United States. They have $6.4 trillion in client assets, 29.2 million brokerage accounts, 2 million corporate retirement plan participants, 1.5 million banking accounts, and serve 13,000 independent advisory firms. Overall, I think this is a great move for TD. Again, going back to that generating other sources of income. And I think this is a great way to grow revenues in a low interest environment. Another positive I see with TD is their digital adoption. Now, this first column refers to customers that have logged in online or on their phones in the last 90 days. And this is shown as a percentage of the total customer base. For Canadian retail, just shy of 60% of the total customers are doing this. And for US retail, just shy of half their total customers are doing this. This, on top of the fact that the active mobile users has increased 11.1% year over year for Canada and 14.1% year over year for US, shows me that the company will be able to eventually reduce some of their overheads and expenses in the future. I really do think that the push towards online banking is significant. If banks are able to greatly reduce the amount of employees they're hiring and storefronts that they have, they will be able to increase their profit margins and therefore reward investors. Now, as we can see, the stock has recovered very well since the start of the pandemic, but I think there is much more upside for this bank to come. Investors are starting to place great importance on this non-interest income, and I think the banks that are most focused on that should see the best growth in the future. Anyway, that's all for today's video. Remember to like, comment, and subscribe to see videos similar to this one.